Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In this video, we'll cover two chapters, chapter 19 and chapter 20, with a little focus on chapter 19, book value based multiples. Let's take a look at book value based multiple. Book value multiple, also called price to book ratio, which is equal to stock price divided by its book value of equities, not book value of other things, book value of equities. So what is the book value of equity? That is the net assets that you can find on the right hand side of the balance sheet, also called a total equity. Total equity, right? Not the combination of all assets, but total equity. So that's a PB ratio. Why PB ratio? Well, the reason why people use P ratio because sometimes P ratio is no good because a lot of companies do not have earnings. They have negative earnings or really small amount of earnings. In that case, P ratio is not indicative of its value. Then we needed to find alternative measure of what we are getting from company. Well, this book value of the equity could be another measure of what we are getting from the company. So this PB ratio can be very useful for us to have alternative view on the valuation of the company based on multiple. So that's a PB ratio. Price is P is stock price and B is book value of equity per share. Right? Because this stock price is on per share basis. Therefore, when you get book value of equity, you need to divide that number with total number of shares outstanding to get a book value per share, book value of equity per share. So that's a definition of PB ratio. Now, you notice that some companies have high PB ratio, others may have low PB ratio. Really depends on if company is creating value for its shareholder or destroying value for its shareholder. And PB ratio ranges is the number ranges around 1. If PB ratio equals 1, that means stock price equals its existing equity. In that case, you would say company is neither creating nor destroying value for its shareholder if PB ratio equals 1. But on the market, you find that most companies have PB ratio greater than 1. If you find PB ratio around 2 or even 3, that is normal. Why is that? Because when a company has PB ratio greater than 1, that means company is creating value for its shareholders. And sometimes you find PB ratio less than 1. PB ratio could be 0.8, 0.5. It looks a really attractive opportunity because you are buying the stock at a discount price of existing equity. Sometimes you might think this is a great opportunity for you to invest, but sometimes you are getting so-called value trap because low PB ratio means the company is destroying value for the shareholder. It's been destroying value for shareholder. How can you so sure that in the future it won't destroy even more value for its shareholders? So low PB ratio means that company is not creating but destroying value for its shareholders. If it's lower than 1, if it's higher than 1, it indicates the company is creating value for its shareholders. So that is PB ratio. So some company has high PB ratio, others may have low PB ratio. Then what are determinants of PB ratio? So here we need to look at its fundamentals. Okay? And here you see some mathematical manipulation, and you can decompose this PB ratio into 1, 2, 3, 4 factors. The first one is ROE, return on equity, which means higher operating performance means high PB ratio. And if a company is doing well, they are creating value for their shareholders, of course, it deserves a high PB ratio. And the second one is payout ratio. High payout ratio means more cash flow returned to shareholders. That's good news, right? And the PB ratio should be higher. And the third one is the growth rates. The growth rates in the future, high growth rates means high stock price, therefore high PB ratio. And the last one, of course, is the discount rate, R, which has negative relationship with the PB ratio. So high cost of equity, high interest rate, high beta will lead to low PB ratio. Okay, so if we utilize return on equities based on expected earnings, then this equation can be simplified a little bit, which is equal to ROE times payout ratio divided by R minus G. It's the same four factor, just a more concise way to express the relationship between those four factors with the PB ratio. So PB ratio have four business fundamentals. ROE, which measures operating performance. Payout ratio, which reveals its dividend policy. R, the cost of equity. Cost of equity reflects the level of the interest, as well as the systematic risk of the individual company, and another very sensitive factor, which is the G, the growth rate of a company. So if you wanted to estimate PB ratio of a company, it's better to look at its fundamentals, and for its fundamentals, you have great opportunity to get a very reasonable PB ratio estimation. And previously, I said four factors: ROE, payout ratio, R energy, and actually, this equation can be simplified a little bit more. And if you do the mathematical manipulation that you see here, this PB ratio can be expressed in the ratio of two items. The first one is the difference between ROE and G. And the second item is cost of equity minus G. So I want you to look at this second equation on this slide. PB ratio equals ROE minus G divided by R minus G. What does this formula mean? Well, this formula means that PB ratio is the relative of return on equity and cost of equity. And this relationship is strengthened by high growth rates. So if growth rate equals 0, then PB ratio should equal to return on equity divided by return on the cost of equities. You see, on the numerator, that is the return. On the denominator, that is the cost. So if company is generating higher return than its cost, then PB ratio should be greater than 1. So if PB ratio less than 1, it means ROE, or return on equity, is lower than cost of equity. And this relationship actually is strengthened by having the future growth of the company. So for example, let's say a company has ROE of 10% and the cost of equity 8%. In this case, the PB ratio would equal to 10 divided by 8, it will be 1.25. So ROE is greater than its cost of equity, right? And the company is creating value, and the P ratio should be equals 1.25. So that's the P ratio. Given 0 growth. Now let's assume that the growth is 4%. 4%. Then when you apply this equation, you will see PB ratio will be improved to 3. 10 minus 4 divided by 8 minus 4. I'm sorry, it equals 1.5. That's 6% divided by 4%. That equals 1.5%. So PB ratio will be lower given the same ROE, cost of equity, but with a higher growth rates. And higher growth rates will lead to higher PB ratio. So this is a more intuitive revelation of the fundamentals of PB ratio. The relative, the comparison between the return on the equity and the cost of the equity. Okay, before we discuss other sales-based ratio and enterprise value-based ratio, let's take a look at another way for us to get a reasonable estimation of PB ratio. One method is to use its fundamentals. You look at ROE, you look at cost of equity, as well as the growth rate to estimate its PB ratio. And another way is to use regression, cross-sectional regression to see what is reasonable PB ratio. And here we have one example. This example showed you European banks in year 2010, and on the table you have lots of European banks, and they have different PB ratio. Right now we wanted to see what is the reasonable PB ratio that each bank deserves based on its business fundamentals. And the business fundamentals can be revealed in two factors here. One is return on equity, the other one is standard deviation. Standard deviation measures the riskiness of the bank. And why not G? The reason why there's no G is because for the banking companies, it's unlikely that in the European certain bank will have great opportunity to expand because the markets of banking in Europe is localized, highly regulated. It's unlikely that the growth rate will be tremendously high or low for certain banks. Therefore, G may not be important in this analysis, but we pick two other factors: return on equity as well as standard deviation. And when we run regression, we'll see that both factors are very significantly determine PB ratio with statistically significant coefficients on both ROE and the standard deviation. The standard deviation is a proxy for risk. And also this regression is pretty good with R square of nearly 80%, which means the variation of PB ratio in those 18 European banks can be explained by, 80% of variation can be explained by two factors, ROE and standard deviation. So this is pretty good regression. And based on this regression, we can estimate the projected PB ratio for certain bank to see what is the reasonable PB ratio for certain bank. And then we compare the current PB ratio with its projected PB ratio to see if it's undervalued or overvalued. And here on the 1, 2, 3, 4, 5th, on the 5th column, we calculate projected or predict PB ratio based on regression results. We plug it in the variable of return on equity and the standard deviation. And for the first bank, we see the reasonable PB ratio would be 0.89, but the current PB ratio is 0.8. Although this bank has a low PB ratio, but actually the current stock price is undervalued because the reasonable PB ratio would be a little higher than that, about 10% higher than that. So this bank is very likely that was undervalued by about 10%. And you can do the same calculation for other banks, and this table will show you that for certain banks, such as Ernst Bank, the Austersbach, I think that is the Austria Bank, located in Central Europe, and this bank could be overvalued by 23% because the credit P ratio equals 2.5, but the projected P ratio should be around 2, so it's overvalued by more than 20%. So that actually established a red flag for you guys if you want to invest in this bank. So this regression gives you another method to see what is reasonable PB ratio for certain company. And you can compare the projected PB ratio with the current PB ratio to see if the current stock price can be overvalued or undervalued. And this regression is also based on business fundamentals. And here we choose two factors. One is return on equity. The other one is standard deviation. And this regression actually are very different if you use different markets. I mean, the coefficients are very different. And also the regression results could be very different between different time periods. And for the US markets, European markets, Japan markets, as well as emerging markets, and here we run another regression based on the data in January year 2013. But here we pick four factors. Because we are doing cross-sectional analysis for different markets around the globe. And those four factors are: first one is the growth of EPS. The second one is beta, which reveals the riskiness of the company. The third one is payout ratio, and the fourth one is ROE. So this is based on the very first equation for P/B ratio. Reveal that the four factors: payout ratio, ROE, and the growth rate as well as cost of equity. And the beta is one part of cost. So here you see, those regressions are pretty good for the US with the R-square of more than 60%, nearly 50% for Europe, and globally a little over 50%, which means this regression pretty good. It's pretty good because more than 50% of variation P ratio can be explained by four important factors: the growth, cost of equity or beta, payout ratio, and ROE. So cross-sectional analysis, cross-sectional regression could be very useful for you to find a reasonable P/B ratio for certain markets, for certain companies. Now here's another regression based on EV and EBITDA ratio. What is the EV? EV is earning, not earnings, enterprise value. And EBITDA is earnings before interest, taxes, depreciation, and amortization. And this is another popular valuation multiples the professionals are using, trying to see if the company is undervalued or overvalued. EV to EBITDA ratio. EV is total value of the company, or I would say it's non-cash value of the company. It's a combination of debt, equity, minus cash. That's the enterprise value. And what actually matches the enterprise value of the company? That is EBITDA or EBIT. EBIT or EBITDA. EBIT is earnings for interest, taxes, and the EBITDA actually includes depreciation and amortization. A lot of financial analysts love to use EBITDA. Why? Because EBITDA is approximation of cash flow. Because when you include depreciation and amortization in this operating income, EBIT is operating income, right? And then when you add this depreciation and amortization, you capture the a pretty good picture of the cash flow situation in the company. So the reason why people use EBITDA a lot because EBITDA is a really good proxy for cash flow in a company. And if a company has positive EBITDA, you don't need to worry too much about this corporation because this corporation is generating positive amount of cash flow. But if the EBITDA is negative, then you do need to worry. Okay, that is regression methods for estimating a reasonable P/B ratio. Now let's switch to another topic, the valuation multiple based on enterprise value, and then this is another popular multiple that the analysts are using, and we have value to, the enterprise. What is the enterprise value? Enterprise value equals value of equity and the value of debt minus cash flow. And and sometimes we use firm value, but firm value includes cash flow. And previously we know that firm value equals free cash flow to the firm divided by WACC minus G, the difference between WACC and G. And if we do the ratio of firm value versus its book value, then we can convert this equation into ROC minus G divided by WACC minus G. So this is another book value multiple, but based on firm value. Previously we use equity book value ratio, PB ratio, that's based on equity value. But here we can use firm value to develop similar ratio, firm book value ratio, and this ratio depends on the relative level of ROC and WACC. What is ROC? Return on capital. What is WACC? Cost of capital. And then the relationship will be strengthened by having a higher growth rate, which is similar to PB ratio. PB ratio equals ROE minus G divided by R minus G. And here, firm value to book value ratio equals ROC minus G divided by WACC minus G. So that is firm value. I would say it's firm value to book value ratio. Regarding EV to EBITDA ratio, and this ratio is getting more and more important among professionals because EBITDA is a very good proxy for cash flows, and you can look at how we can actually decompose this EV to EBITDA ratio into several determinants and amount of determinants. You see, first one is tax rate. Second one is WACC, cost of capital. The third one is G. Right? The fourth one is depreciation amortization. And C is capital expenditure. And also we have change in working capital as well as EBITDA. So this is a pretty complicated equation, but it reveals the basic factors that shapes EV to EBITDA ratio. WACC, G, change in working capital, capital expenditure, depreciation amortization, as well as the tax rates. Other than using this EBITDA, we can also use sales as the base of EV to sales ratio, and here we look at the relative valuation based on EV to sales ratio. And for a lot young companies, they don't generate any decent amount of EBIT, they don't generate any net income, but all of them have some amount of sales. So sales could be a good denominator for you to utilize to develop certain valuation multiples. And here is EV to sales ratio. Of course, you can use stock price to sales ratio. Here we use EV to sales ratio or even firm value to sales ratio. And this EV to sales ratio can also be decomposed into several determinants such as operating margin, reinvestment rate, the growth rate, WACC. If you use two stages, then you have different numbers for the two different stages, but here you see the fundamentals of EV to sales ratio. And in this table, we run regression among different markets to see what is a reasonable EV to EBITDA ratio. And as I said, the regressions are different through different time and on different markets. But the key factor that we're using here is growth rate, tax rate, and DFR, depreciation amortization. I need to check the tax rate to see what is the detail. And previous regression question based on January year 2015, but if you run regression another time, you will see different results from the regression, and also R squares are pretty different. Previously, it's single digit, but right now the R square increased to double digits, 17-19%. It's pretty good. I mean, it's not great, but it's pretty good. Reveals the fundamentals, the impact of fundamentals on EV to sales ratio. Previously, EV to EBITDA, here the EV to sales ratio. By the way, this DFR is debt ratio. Okay, you have a lot of questions, and I know the question that you would ask is, which multiple is the best multiple for you to utilize? Because right now we have a lot of multiples to utilize. Let me show you the big picture. We have a lot of multiples to utilize. First of all, we have several ratios based on stock price, PE ratio, PB ratio, PS ratio, as well as PG ratio, right? 4 price related ratios. And also we have 4 other firm value based ratio or enterprise value based ratio. Firm to free cash flow to the firm ratio, firm value to after tax EBIT ratio, firm value to EBIT ratio, and firm value to sales ratio. There are a total of 8 ratios, and from this picture you know that for each ratio we can look into its fundamentals, such as for example, for P ratio we have 3 fundamentals: G, payout ratio, and riskiness, which can be captured by either standard deviation or beta of the company. And for P ratio there are 4 factors: ROE, payout, G, and risk. Once again, can be captured by beta or standard deviation. And for PS ratio we have net margin, the profit margin of the company, payout ratio, G, and risk. Now for firm multiples, for example, for value to EBITDA ratio, we have 1, 2, 3, 4, 5 factors: growth rate, investment rate, tax rate, cost of capital, as well as the growth rate. 1, 2, 3, 4, actually 4 factors. And for value to sales ratio, we have determinants of operating margin, investment rate, the growth rate, and WACC. So the last question is which multiple to use, and I think I cannot give you 100% correct answer, but I will show you the best practices based on this table. It's really depend on the scenario that you are facing when you're analyzing certain stock or certain industries. And here, this table shows you that for different sectors, for different industries, certain multiples could be better than the others. For example, in the cyclical manufacturing sector, the multiples that could be very successful for you to reach a fair valuation of the stock would be P ratio and PEG ratio. And for this sector, you need to do earnings normalization, and because this sector is very sensitive to business cycle, and once you do earnings normalization, then P ratio can be very powerful and a useful tool for you to utilize. And for the growth companies, P ratio, when you use P ratio, you need to be very careful. Therefore, you need to focus on PEG ratio, because a huge impact of the growth rate on its PE ratio. And for young company that has current losses, and the young company don't generate net income, they don't pay dividends, they may not even have positive free cash flow to equity or free cash cash flow to the firm. Here, the better multiple for you to utilize would be sales or revenue-based models such as PS ratio, EV to sales ratio, so on and so forth, because you don't have other choices available at all. So that is for young company. For infrastructure company, typically have high leverage, low risk. EV to EBITDA ratio would be very useful tool for you to utilize. And also infrastructure company tend to have big depreciation amortization, and EV to EBITDA ratio capture. I mean, depreciation amortization is a key determinant of EV to EBITDA ratio. For REITs, what is REITs? REITs are real estate investment trusts, and for REITs, we use price to CFE ratio, and CFE is a very unique measure of cash flow for REITs, where CFE equals net income plus depreciation. And when you include depreciation with this net income, you are getting a very close approximation of cash flow in a company. And for REITs, this price to CFE would be a very useful multiple to utilize. For financial company, although you can use dividend discounting model, but not cash flow based model or other valuation multiples, but the most useful multiple would be P/B ratio. Sometimes people use P/E ratio, but since earnings tend to be volatile among the financial companies when they go through business cycle, and sometimes P ratio may not be that useful, but here I want you to know that P ratio would be a very good indicator of valuation among the financial services companies. And then finally, for retailing companies, revenue multiples can offer greater value when you include them into your analysis. So it really depends. It depends on the nature of the business and the industry the companies are operating in. And there's no 100% accurate answer on which multiple to use. But this table offer you a best practice that you can utilize in your future financial valuation work. Okay, that concludes chapter 19 and chapter 20, pretty straightforward chapters. And for those valuation multiples, PE ratio, PB ratio, sales-based ratios, I want you to know that no matter which ratio that you are going to use, you have two methods to justify if certain ratio is high or low. The first one is look at its fundamental determinants, right, based on those equations. And sometimes equation can be very complicated if you use two-stage model, but on D2L you can find three calculators that are provided in Excel spreadsheets regarding two-stage model determinants formula for PE ratio, PB ratio, and PS ratio. That's the first thing. And the second method that you could utilize to justify if a multiple is reasonable is through cross-sectional regression. You collect data for similar companies operating in given industry, or you collect data to compare different markets. Then you regress certain multiples with its determinants. Then utilize the results of regression to find out the projected P ratio, PB ratio, and then compare that projected number with the current number to see if certain stock or certain market is overvalued or undervalued. So two basic methods, fundamentals, right, based on equations, and this regression method, which is also based on fundamentals. So very useful for you to identify if certain ratio is reasonable for certain company, for certain industry, or for certain markets. So that concludes this week. I would say regarding learning material, we are slowing down in this fourth week. However, regarding the assignment that you need to deal with, we still have a lot of work to do. Second exam is due next week. You probably need to work really hard on your second exam because you have more lengthy process to deal with for each every problem solving. You definitely need to spend more time in second exam than your first one. And the second, it's time for you to work really rigorously on your valuation projects. In this week, I expect you guys complete 10K report reading, the parameter building, the parameter. At this point, you should be able to know how do you estimate cost of equity, cost of capital, the weights of equity, weights of debt, risk-free rate, beta, everything. And then this week, I want you to focus on financial analysis of the company by doing historical comparison, peer comparison, most recent quarterly financial ratio analysis, as well as the management guideline regarding what will happen for future quarters and future years. So that's financial analysis. And then next week, I expect you guys to put everything into your valuation models, and you have to use at least one cash flow based model, either free cash flow to firm model or free cash flow to equity model or DDM model. And then you utilize a couple valuation multiples that we learned during this week. P ratio, maybe EV to EBITDA ratio, or PB ratio, so on and so forth. I want you to use the multiple methods in your valuation part of your project. Right? So that's work that you needed to deal with this week. And I hope you enjoyed this video, and I will see you in next week. Thank you so very much.